Hannah Kessler.
This gal started her own bank at the age of 18, and then you became a self-made millionaire by the age of 24?
I did.
Hannah Kessler is a money mentor.
She's known as the single millionaire chick.
With advice on how to stop living paycheck to paycheck.
Money
Starts with your mindset.
How you think about your money is going to greatly impact how much money that you have.
I grew up in a town called Olathe, Kansas. I'd be walking out of the door, going to school, and my mama would holler at me, "Hannah, make good choices." And I'd have to holler back, "Because the choices I make today will affect my future."
My parents, they did a very good job about teaching me as a child how to handle my money. We have a lack of understanding when it comes to money.
If you want your kids to have money, you need to start talking to them about it while they're young.
I'm really second generation to this concept that's called the infinite banking concept.
And at 18 years old, my dad gave me the choice to start my own bank that then led me to becoming a millionaire by the time I was 24.
Now you've written a book to help tie it all together.
So the companion is really just teaching kids that, not specifically money, but really important life lessons.
Now being the owner of the Money Multiplier, I help serve over 17,000 clients in every state of the country.
Where can people get the book?
HannahKessler.com. Hannah spelled the same way forwards and backwards, Kessler with one S.
Also, I got my podcast show, the Money Multiplier Podcast.
And make good choices today, because the choices you make today will affect your future.
Good morning, my friends. Good morning. Good morning. How we feeling today? Dexter, good to see you on. Hey, one thing I noticed, I was actually having a conversation with my father and my older brother this morning. I'm going to go tour colleges with my niece. She's going to be 17 in May, and she's a junior right now. She's going to finish her senior year next year. So actually, she'll be a graduate, I guess, of the 2027 year. Crazy. I graduated in 2017. Oh my gosh, 10 years ago next year. That's crazy. Life moves so fast, y'all. That's why you got to stop and smell the roses once in a while. That's why I love my kitty cats. Like every time I walk by them, I'm like, ooh, pets, pet Daisy, pet Momo. So I was talking with them because I'm going to go up there in June, the first week of June. We're going to go tour some colleges. She was looking at a school in Tuscaloosa. I was like, I know Tuscaloosa. I think I've driven by it in my van once or twice, but I didn't even know there was a college there. All right, don't come after me, Tuscaloosa fans. I'm not into like football and like college and, basketball and all that stuff. But good morning, Mr. Alfredo. Good to see you, early bird. Hello, aloha, my friend. Actually, Mark, are you still in Hawaii? If you're still in Hawaii, it is literally, is it midnight there right now? Crazy. Good evening to you, sir. And Mike, good to see you, my friend. All right. Well, hey, so I'm excited. I ended last week with a fun conversation. And I know I was a little moody. Thank you for bearing with me, y'all. But today's episode, we're going to get into part 2 of our paid up editions. I want to share a personal story. And also, we're going to get into the conversation of IULs. Now, stick around to the end because we are going to talk about the lawsuit between Pacific Life Insurance Company and Kyle Busch. He's the famous race car driver. I haven't even looked this up. Kyle Busch, is that the reason Busch Beer exists? Is that his company? I don't know if that's a stupid, naive comment, but I'm just curious. Chime it in the chat box if you know. All right, but without further ado, okay, this is kind of an episode for my infinite banking vets as well. We're going to get into illustration talk. I'm going to start this conversation and put some illustrations up on the screen. So for my people who are listening to this past recording, and maybe you are on podcast, you may want to hop over to the YouTube channel, The Money Multiplier or Hannah Kessler, and you can see the illustrations on the screen that way. So, oh, he says it's 3 a.m. Okay, my math was a little off. All right, 3 a.m. there. Okay, good morning, early bird. All right, so hey, so let me add this illustration to the screen for a second. The conversation I want to get into is how, if I'm going to be my own banker and I play honest banker, when I take out those cash value policy loans and I pay myself back and I charge myself interest, how is that really going to help me, Hannah? You tell me all the time that if I continue to treat my money with the same respect that I treat the banker's money, how is that really going to help me? Like, I'm a visual learner. I need a visual example on this. Okay, so this is really for you folks. Now, here's a policy illustration from an insurance company, one of the 6 insurance companies that I personally do business with. And just a reminder too, like, because everybody wants to know, you guys keep having questions. So let me just kind of flow with this. But like, why do I choose one insurance company over another one? Like when I'm talking and working with my folks, really it comes down to how are we designing that policy? Like, is there going to be a large dump in the first year and then smaller ongoing premiums? Do you want flexibility with that paid up additions? Like, you can even design policies to have subsequent year dump ins. Okay, so, but that only works with Lafayette Life compared to like One America, because at One America, they allow year 1 dump ins, but then year 2 and so on, that paid up addition premium, we're kind of capped. And to get real technical, we're capped at 3 times the base premium. That's what we can do in like sub-year dump ins. Okay, but I'm going way too deep into that. You guys really don't need to know all that. But what you guys need to know is that there's reasons why I pivot folks to one company over the other. Policy design, maybe there's some health challenges, maybe age even, like my folks who are 60 plus, I like taking y'all to companies like Lafayette, Guardian, Security Mutual sometimes, they're great. Penn Mutual, it could be a great place too. And then, even different quirks of like, well, some companies are direct recognition, some companies are non-direct recognition. Actually, let me make a note. We can talk later on in another episode, direct versus non-direct, the differences and what you need to know. All right, that would be a good topic. So anyway, so that's why we have the 6 different companies, right? And to provide more context, if I'm new to you, hey, thanks for being here. Good morning. That's what the Money Multiplier does, right? So like my active business, the Money Multiplier, started from my father, and we're an independent brokerage, right? So we work with these different insurance companies, but we're just 100% the infinite banking concept. So that's really what I do. Yeah, do I do a little bit of like convertible term? Maybe we can get into that conversation. Or if you listen to my podcast show with Mike Samet not too long ago, we talked about asset-based long-term care. Real quick on long-term care, just a little update. Nanny and Papa are doing great. They moved into the assisted living place on Thursday last week. I was out of town. I left town Thursday, came back home Monday evening. So yeah, I'm playing a little bit of catch up in my email. So I've been replying to y'all though and saying, hey, I got this. Just give me a little bit. I'll get you a reply back. But so I was out and then I came home, and then on Tuesday I went and visited them. Nanny is happy as a clam. Okay. Yeah, she's got dementia, but like she's Nanny. She's doing really good. And then Papa's a little depressed, I'll say. Okay. Like I get it. It's a big change, but you're closer to family. No one was in Texas anymore. Uncle Brad and Aunt Sandy moved to Houston. So literally nobody's in Texas and everybody's in Florida, well, or not in the Dallas area, right, where they were living. So it's good. And I'm excited to hang out with them more. And this assisted living place is amazing. Like when I walked in for the first time, I had to check in as a visitor. And she says, hey, who are you here to see? And I said, hey, I'm here to see my Nanny and Papa. Gave them gave her their names, and she goes, "Oh, they just moved in this weekend. Yes, they were down here for dinner tonight." Like they just really, really care. And to go back to another episode that we talked about not too long ago, things that will take you far in business. If you care about your people, I'm telling you, you'll create loyalty, you'll create good energy, good vibes. People want to hang out with you, be with you, work with you. And that's just how I feel of this assisted living place. It's a good place. And it's right outside of where mom and dad lives. It's literally 5 minutes away from mom and dad's house. So very nice. Okay, ADD brain, let's get back on track. This policy illustration is from an insurance company actually called Lafayette Life. So, right, just reminder, okay, what we talked about last week, the differences between guaranteed and non-guaranteed are just the dividends, the projected dividends. I can't sit here and promise you dividends in your policy, but these insurance companies, Lafayette Life being one of them, have been paying out dividends consecutively for the last 120 plus consecutive years. I'm pretty sure Lafayette Life now is at 129 or 132. I can't keep my insurance company sometimes straight, okay? But that's why I always say 120 plus consecutive years. So right, when I look at the illustration and I'm reading the cash values, year one, I always look at the guaranteed side because obviously I haven't had my policy for the full year yet, thus no dividend has gotten paid out yet. So to give me like projected like year one, month one cash values, I look at the guaranteed side. So starting on the left-hand side, you have the age, you have the year of the policy, contract premium, how much am I putting into this policy out of pocket each year? And so I just did like a $1,000 a month, $12,000 a year illustration just to give us something to look at. And then, and reminder, you decide your premium, okay? I had a friend over yesterday, Christopher, if you're listening to me, hi, good morning. But I had a friend over yesterday and he asked me, he says, so like, how much do I really need to start one of these policies? And it's literally you get to decide the premium that you want to deposit into your policy. I started at $400 a month when I was 18. I was saving $100 a week. That's $400 a month. That's just where I started. So you decide premium and you can pay premiums monthly, quarterly, twice a year, or even annually. Okay. But year one, do you see underneath net cash value, it says 7283. So I'm going to have 7283 made available to me. Now, let's get even more specific for a second. People will ask me, Hannah, how do I know the correct mode of premium to pay inside of my policy? Well, honestly, pick the premium mode that matches best to your net cash flow situation. Or sorry, that was, let me say that again. Choose the premium mode that matches up best to your cash flow situation. So what I mean by that is if it's better for me to do monthly right now, because it just works out better for my cash flow, do monthly. Me, if I can, I try to pay my premiums on an annual basis. 7 of my policies, I pay them annually. 1 of them, I pay it monthly just because I'm an investor. When I get that interest income every month coming into me, it just matches better for my cash flow each and every month. So that's why I have the monthly policy, right? The difference is, and you can always change this. You're not locked into like annual premium forever and ever. You could like, if right now you do annual, but the next year you need to switch it to monthly, you can always do that. Okay. But how does that play with the cash value that's going to become available to me in the policy? Here's what happens. Year one, if I pay this full $12,000 of premium, year one, month one, I'll have $7,000 of cash value. Now here, I got to say this though, okay, to be totally specific. Now I feel like I'm compliant, but like the illustrations here, they are showing end of year values. So it's showing me the cash value with the interest I earn throughout the year. So literally at month 12, my cash value on the guaranteed side is going to equal that 7,283. So what I tell y'all, just to be conservative of like what to expect year one, month one, is I take that 7283 and I just take 90% of it. 6,554. So $6,500 is what I tell you conservatively that's going to be made available year one, month one. So 12,000 gets deposited in. I have access to 65% of it year one, month one. That's what I tell you conservatively. It's better in real life, but I always operate off of the principle of under promise and over deliver, because I'd rather the numbers be better in real life, right? That'd just be better for me. So that's how I read year one cash values is 90% of that cash value. Now, let's say though that I'm doing a monthly premium and every month I'm putting in $1,000 every month inside of my policy. So all I tell you there is it's the same thing, but just each month I'm building up the cash value. So the difference here would be each month when I'm putting in my 1,000 monthlies, each month, my cash value in the first year is going to be building up by $650 every single month. You see what I'm saying? So it's just 65% of that monthly premium that I'm depositing in. So that's why, like, for my folks, like, let's say you're using this for debt payoff, okay? Because, I mean, and here's the thing too. Jules, if you're listening right now, I'm talking about you. I had a Zoom meeting last night at 7:00 Eastern time, and very, very smart two gentlemen. He brought his friend to the call as well, and it was myself and Rachel Katz. Shout out Rachel Katz. She is a wealth of knowledge and so amazing. So go see what she's all about. Rachel Katz, Katz as in zebra, and her company is Key to Debt Free. So if you go to Instagram or Facebook, key to the number 2 debt free. You'll find her on there. ADD brain. And then I was going to bring that up about the premium. What was I going to say? Premium. Shit, y'all. That's okay. If it's important, it'll come back to me. I guess maybe my message there was shout out Rachel Katz. Okay, it'll come back to me. It was something that was said on the call with Jules. Damn it. All right, that's all right. Whatever. So year one cash value. We talked how I figure out the year one, month one. Oh, I remember I was going to say, here's what I tell my debt people, okay? Because if you have debt, yes, use the policy. But y'all, even if you don't have debt, this system still works for you. I don't got debt. I got good debt, because not all debt is bad debt. But if you don't have any bad debts, people always ask me, well, I don't have any debts. How is this going to work for me? Y'all, your money has to be stored somewhere, right? And so I think it's better, the best option for me to keep my money stored within my policies, okay? But for my people who do have debts, because 78% of Americans are living paycheck to paycheck. That's based on a Fidelity report. And 78% of Americans are living paycheck to paycheck. So that's just where the masses are at right now. People have been leveraging banks. They're just in debt right now. And so that's what they want us to help them with first. And that's what I would tell you. If you have any bad debts, that's where we're going to start first. And if I'm doing a monthly premium, what I tell y'all in our second strategy call, okay, because when you get approved for a policy with me, we're going to sit down on a Zoom call and we're going to walk through strategy. We're going to walk through your illustration together, and we're going to confirm everything before you sign or accept any policies. So when I'm having that second strategy call with my clients and they are a debt payoff person, that's what our first goal is. And let's say they're doing a monthly premium mode, what I tell them to do is year one, month one, take out your cash value. Take out the $650, see how it works, see how quickly you get the money, and enroll yourself into the direct deposit, right? Because that's like the first question. People go in there, take out a loan immediately because they're like, is this stuff really true? Or is Hannah and Brent telling me the truth? You guys say that all the time. and then once you realize it's the truth, then you come back a few months later and start with way larger premiums. You're like, shit, I should have started my first policy with a lot more in premium. But anyways, and I have stats there. We can talk about the stats later. But if you are a debt payoff person and you're doing a monthly premium, what I tell you to do is year one, month one, take out the cash value. See how quickly you get the money, see how the process works. But then from there, I would encourage you to start taking out the loans on a quarterly basis, because then you just have those 3 months that you're building up the cash value. 650 times 3 is, what is that, $1,500? I'm really bad at mental math. 650 times 3. 1950. It'd be 1950 that I can go deploy and go pay off debt. So now I'm just doing it quarterly, taking out these policy loans rather than like every single month. Because, I mean, if you're trying to take out 650 loans every month, I mean, sure, you can. But at that point, you're just kind of playing mental gymnastics with the insurance company, So, okay, 1,000 a month go in. We are talking about the guaranteed cash value. Now, year 2 and so on, that's when I start to look at my non-guaranteed side. And I like Lafayette Life's illustrations here on this one because they have that third column from the right. Do you see where it says increase in net cash value? So they have the increase column, and then they have the one right next to it, which is net cash value. So the net cash value, second column from the right, that is showing us our cumulative bucket. How much in total cash do I have? Now, I like the increase in net cash value column as well, because I just essentially don't have to go in here and do any additional math. So how this is reading is year 2, I put in my 12,000 of premium and my cash value grew by 10,419. That's how much it grew by that year. Think about your policy like you're starting a business from scratch. Year 2, it's my business. Ooh, my video just went out. Okay, we okay? All right, good. So I said, think about your policy like you're starting a business from scratch. So by year 2, I put in 12,000 and my cash grew by 10,400. If I take 10,400, divide that into 12,000, that's an 86% growth. So year 1, my profits in my policy or my business was 65%. Year 2, it's 86% growth. Okay, I'm not breaking even yet in my business. We just started it, but we're trending in the right direction, right? Year 3, I put 12,000 in. Now my cash value grew by 11. If I take 11,000, divide that into 12, that's a 92% growth. I'm not breaking even yet, but I'm almost there. By year 4, it's close enough for government work, right? You put in your 12,000. Now the cash is growing by 11,700. And then definitely by the 5th year, you put in the 12,000 and now your cash is growing by 12,477. So I'm literally walking away with $477 more from my policy than what I put into it that year. So there's 2 break-even points that I look at when looking at policies. The first one is the cash on cash in that year. So here it would be between year 4 and year 5. That's my cash on cash. When I put in my 12, when does my cash value grow by that same 12? And then I also look at the accumulative cash on cash. Okay, over these 10 years, I put in $120,000 inside of this policy. When does my cumulative cash value bucket exceed that 120 that I put into it? And I believe it's happening in year 8. I just got to do some math because on this illustration, it doesn't show us a cumulative premium column. What's 12,000 times 8? That's 96,000. Yeah, by year 8. By year 8, I put in a total of $96,000 into this policy, and my cash value bucket is 96,589. Do you see where I'm pulling that number from? I know StreamYard is a little different than Zoom. I don't think I have pens. Oh my God, do I have a pen? No, that's not a pen. That's changing my layout. Anywho's, there's a lot of layouts I haven't played with on here yet. So that's my cumulative. All right. So by year 8, my cumulative cash on cash happened. And then every year after that, I just have profits greater and greater than the year before. Now, shout out Jules again. Here's what Jules asked me last night as well. He says, well, hey, what if after year 10, because Hannah, I'm in my 50s right now. What if after 10 years, I don't want to keep paying this premium? I don't want to keep working my W-2 job or doing XYZ? Or what if my investments go down? Okay. Because remember, your policy is not your investment. The policy is just a place you store the money, grow it, protect it, control it, right? Through your policy is how you go buy the investments, the purchases in life. Okay. But he goes, hey, by year 11, what if I don't want to keep paying premiums anymore? Is this policy efficient? Like, can I just stop paying premiums? And here's the answer. You can if you wanted to, but here's how I answered it back to him. I said, but Jules, look, year 11, you put in $4,200 inside of this policy, $4,200. Your premium drops because how I just designed this one just for learning purposes, the paid up additions is dropping off in year 11. So in year 11, if I put in $4,200 and my cash value grew by 10,000 and some change, do you see that 10,169 underneath the increase in net cash value column? If I put in $4,200 and I immediately have 10, how long would you stand on my driveway, hand me $4, and I turn around and hand you $10? How many times a day would you play that game with me? He says all the time. I'd come and be here 9 to 5 business hours all day, every day. Exactly. That's the exact answer. Why would you ever want to stop that compounding growth? But if you really, really wanted to, look at that dividend, $6,216. You could literally use your dividend to pay your base premium if you really, really wanted to. You could. Or if you really, really wanted to, you could even change the policy to what's called a reduced paid up. RPU for short is what we call it in the industry. But you could even reduce pay up the contract. Basically, no more premiums are being paid. Your death benefit would reduce, okay? Because if you have seen my podcast episode, let me put this in the chat box because this was a very good episode, especially for like my mechanics, like my engineers, and like you love like go into the weeds like with me on policy designs. Let me put this in the comment. There's a YouTube video you should watch on a past podcast episode, like maybe 3 weeks ago that launched. I brought that up and then I forgot. Oh, RPU. Because you can stop paying premiums, but if you do RPU the contract, your death benefit will reduce because the death benefit is literally just the net present value of the policy at that time. And if the insurance company knows that no more premiums are coming in from you, the policy holder, they're going to reduce down that death benefit, right? Because you haven't paid up the policy yet. You paid up the policy at age 121 if premiums are being paid until 121. So that's why the death benefit reduces, because you paid up the contract. Okay, you don't want to pay any more premiums, totally fine. No more premiums. Death benefit's going to get reduced to the net present value of what it's at. And you still have your cash value bucket. You still earn interest. You still earn dividends in your policy. It just means that there's no more future out-of-pocket capitalization that could be happening if you did continue to pay those out-of-pocket premiums. Okay, that's what it's saying. Go back and rewind that and put me in slow-mo if you want to hear that again. But this kind of leads into, I think naturally, well, Hannah, then is my death benefit just going to remain level at exactly where it's at if I do RPU the contract? No, it's going to continue to increase because of those dividends and how they go back inside of our policy as more paid up additions. That's why the death benefit continues to increase. Because look at the death benefit like in year 15 on the guaranteed side versus the non-guaranteed. Do you see how they're a little different? And on the guaranteed side, death benefit just remains level at where it's at. It's because that's assuming no dividends get paid out. But as we know, full circle, these mutually owned insurance companies, the one I personally do business with, paying out dividends for over 120 plus consecutive years, those dividends will strong and likely continue to keep paying out. So death benefit's going to reflect more on the non-guaranteed side as too, and that's it will continue to increase even if you do RPU the contract. Okay, hold on. So I got some comments coming in. Okay. Lord underscore 1775 says, hello, can you explain how/why the money multiplier refers clients to a different company, key to debt free, who is not an IBC authorized practitioner? Very concerning, but I'm curious if the reason. Okay, yeah, let me explain the story behind Rachel. So Rachel, her business is credit repair, business funding, and student loans. She is a wizard at student loans. Rachel was a client for a long, long time. She started hanging around in 2017. And Rachel started her first 2 policies on her boys. She has 2 sons. She started there because she's like, hey, I can really only afford like $500 a month. And I want to do this for my kids because I want to start using this to fund their life expenses. Because my parents didn't set me up. I want to make sure I set up my kids. That's just more important to me right now. So she did 2 policies, $250 on each of her baby boys. So she was a client and she had this other business, right? And now Rachel, she started her 3rd policy. She just bought a new car with a 3rd policy on that 3rd policy because her business has been so successful these last few years. She had dump-in money. She did a dump-in into that policy, her 3rd one, and it's on her now. So the insured person is her. And then she did a dump-in, and then year 2, it's going to drop down to lower ongoing, more comfortable premiums. And the reason she did a dump-in is she goes, hey, I'm about to buy this car. I don't want to just buy this car in cash. I don't want to bank finance it and give all my interest payments to the bank. I want to use my policy, but I got the money right now. How can I take this money, do a dump-in inside of it, right? So anyways, that's her whole story. So now actually I'm taking her under my wing. So just FYI, she is a student of the Nelson Nash Institute, becoming an IBC practitioner, but it's schooling, y'all. I mean, it literally took me about a year to get my IBC practitioner's certification and to get authorized. I think I got authorized like in 2018, 2019 or so. And it's expensive. Okay. You have to pay this annual fee. You have to actually get accepted. You have to have an interview with Carlos Laura. Robert Murphy's no longer there. And David Stearns. And I'm pretty sure David Stearns is Nelson's son-in-law. Okay. And I'm pretty sure David Stearns has really brought in his daughter into the business because I've been seeing her run some stuff. So that's another resource too. If you want to go to YouTube and look up, and I think it's just under the Nelson Nash Institute, or I think it's under infinitebanking.org. I don't know, but they do have a YouTube channel. They have a podcast. Dad's been on their podcast before. I'm just waiting to get invited. David, holler at me. We talk. Invite me, bro. But anyways, so that's Rachel. So yeah, just to give you more context, I'm taking her under my wing. And she just kind of helps me on some of my overflow strategy calls, and she's been even teaching her students this because once she helps people minimize their student loan payment, she literally helped a nurse paying for herself and her 2 kids. She was paying over $7,000 a month towards student loans. And Rachel, because of all the state-sponsored and government-sponsored plans that are out there that they just don't tell us about, she got that payment minimized to $300 a month. So then what Rachel says is, okay, now $7,000 minus $300. Holy shit, man. You got $6,700 that you no longer have to send to them. Take some of that money. Now let's start redirecting it into policy premium. And so just naturally it kind of flowed into this. But that's why. And two, because I don't want to be an expert in everything, y'all. I want to just be an expert in infinite banking, and I want to know enough to make me dangerous about taxes, about crypto, about stock options, about estate planning, trust, LLCs, blah, 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 right? I want to know enough to make me dangerous, but I'm not going to be the expert there. I'm going to help you set it all up. I'm going to refer you to those different experts in those different areas. You see what I'm saying? Because I'm telling you, if you try to just be an expert in everything. What's that one saying? Somebody chime in and say it. It's like, if you try to be an expert in everything, you're actually an expert in nothing. It's something like that, right? You catching my drift? So Lord, good question though. Good question. Good, Dexter. Yep. Year 8, interest and dividends can pay the base premium. Yep. Okay, thank you for explaining that. NNI makes it important to learn from authorized practitioners so you don't get bad info. Yes, sir. That's why I say it all the time. I say, hey, even if you don't like me, you don't like my father, you don't like Chris Noggle, you don't like Rachel Katz, maybe you vibe with Caleb Williams or Mary Jo Ehrman or James Netherly, right? Ryan Griggs. Maybe you vibe with those other people a little bit more. That's okay, but just go with somebody who is an authorized IBC practitioner. Now, I'm going to do my marketing plug, though. I think what makes us different and why people come to us is because of the implementation in our mapping team. You know, we have 5 folks over there that this is all that they do is once a policy goes active, they will want to have a sit-down Zoom meeting with you, and they're going to build out other visual tools to help you use your policy. And that's just a free service that we do for all of our members. So you go, when I'm talking about policy tools, you'll see it in the presentation. You'll see the car example. That's the cash flow analysis. And then you'll see the money multiplier map. And that's just the tool that we build for debt people. And then also, like, even for my investments, bringing it back to you, Jules. Even for my investments, like some people, they're such big number nerds that they're like, well, Hannah, I want to map it out and I want to track my spread on my investments. If I take my cash and just go do this investment directly versus if I flow the money through the policy and then go make the investment, what's the difference? If I go from point A, or if I go option A versus option B, what's the difference there? And that's where a tool was created called the gains projector. Okay, you know, it's just, I don't know, it's stuff that we do just try to help you. Okay, I want to pivot though here for a second. Good morning, Miss Annette. Good to see you. I wonder if you and Alfredo are with each other today. Hold on, let me sip my coffee. Okay, now I want to just talk briefly on kind of getting into what Nelson talks in his book, like with the equipment financing chapter. If you use this policy to buy the things that you're already going to go buy in life, the larger the numbers will become. And he goes through the examples of using one policy to finance one truck for his trucking business. Nelson was a forester, right? So he had this equipment, he had the trucks. And he showed the difference if I financed 1, 2, 3, and 4 trucks for my forestry business. What is the difference? And he noticed that when he used the policy to buy the 4 trucks versus just the 1 truck, you had more cash value, thus meaning more cash flow during retirement years. And really, the answer is it's this simple. It's just more paid up edition premium. Literally, and this goes back to Nelson's laws. One of his law is capitalize, and do not be afraid to capitalize, okay? And this is Nelson's law about capitalization. I say it in my Gen Z terminology. I say money is going to flow and grow to where it's respected to. My team, I need like that on a t-shirt, or I need a pillow. Okay. And I can like put it over here. but all he's saying is that when he played honest banker and he financed the things that he was already going to go buy in life through his own banking system, the larger these numbers became. So I want to show you this illustration. This is literally the same exact policy design as the one I just showed you on the $12,000 a year one. But all I did differently is I showed us paying an extra $500 a year into paid up additions. Because here's my thought process with this illustration. I was like, you know, let's say I'm going to use this policy. I'm going to put away $1,000 a month, and I'm going to pay yearly my $5,000 property tax bill with this policy. What's going to happen to the numbers here? So how I thought about this is I said, okay, well, if I have a $5,000 property tax bill, I'm going to have no less than $6,500 from my cash value. So I can immediately go and pay for this property tax bill. Let's say it's $5,000. Well, I'm going to take that $5,000, go pay the property tax people, and then now I'm going to pay myself back and I'm going to charge myself interest, basically looking at this as me saving back up for when my next property tax bill comes due. So if I want to charge myself, I'm easy. I'm very simple, okay? I charge myself 10% interest. 10% interest is just easy math. And that's how I thought about this paying myself back and how I got to the $500 figure, because $5,000, 10% interest, that's $500. So let's say that I pay myself back with interest, and that extra interest is another $500 each year. You guys follow me? Does that make sense? I want us to pay attention to year 10. Let's look at the cash value in year 10. It's $135,526. I'm looking at the non-guaranteed side. $135,526 is my cash value, assuming I take out the money, I pay the property tax bill every year, and I pay myself back that 10% interest, which is $500 a year. $135,526. Let's look at my other illustration. Let's say I don't pay myself back with interest and I only pay back the $5,000 a year. Year 10, 129. 129,291. 129 versus 135. What do you want? You want 135 or 129? Actually, here's where my thought process is going now. I don't even know the answer to this. And I don't know if this is going to be good or not, but let's just thought process for a second. What did I say? 135 minus 129. What is that? That's actually 6,000. So literally, because 500, what is 500 times 10? 5,000. So over the 10 years, I've put in $5,000 extra as extra interest, extra paid up additions into my policy. And I have 6,000 of extra money by doing so. So literally I made money. I made $1,000 just because I played honest banker and I paid myself back and I charged myself interest. Whoa, that's fun, right? Making money out of thin air, baby. Uninterrupted compound interest. Albert Einstein says that compound interest is the eighth wonder of the world. Those who understand it will earn it, and those who don't will pay it. That was fun. I didn't do that. I've never done that calculation before. Okay, 2 seconds. Lord is commenting. He says, if we do set a policy through Rachel Katz, do you still have access to the money mapping team? Yes, sir. Yeah. Rachel Katz is on the team. Everybody who is a money multiplier mentor, you guys will all have access to the implementation, the mapping team. So like all of like even Chris Nagel's people, right? Brian Faust, Jason Sipple, Mike Samet. I have Kedrick on my team, Kedrick Marcotti, Rachel Katz, Sandra Fry, Mike Fry, right? There's a lot of us kind of like money mentors who we just found our passion. You know what's fun? Everybody was clients first. Okay, I'm not going to spend so much time on this because we're coming here almost to our hour, but everybody was clients first. They're all clients. Even Chris Nagel. Chris Nagel was a client of my dad's for a long, long time. They found their passion, because you got to be practicing what you're preaching. I can't tell you how many people, like I'll get off stage or like I'll get voicemails from people. Hannah, I want to do what you're doing. You know, my first question is, well, do you have your own policy? Are you actively implementing this in your life? No, not yet, but I want to start teaching this full time. And then, you know, their next question that comes out of their mouth, how much commission money am I going to make on a policy like this? Yeah, I'm already done with you because you ain't doing this for the right reasons. Here's another quote that I live by almost every single day of my life. It's a Zig Ziglar quote. If you help enough people get what they want, you in return will get what you want. I don't even know how to look at my damn commission statements, y'all. I look at my bank accounts and I keep track of my cash flow, but I don't know how to log in and look at my freaking commission statements. And that's something I need to do. My mentor's like, Hannah, you need to log in and look at that. And I'm like, I know, bro, I know. Anyways, this hasn't been important to me right now. It's been working out. Annette, thank you. She says, let's type the channel, hit the like button. Yes, please. Hit the like button. Help me over here. Help get this message out. Hey, Jet, just FYI, I talked to Trenton on Tuesday. Him and I are connected, so thank you. Trenton is Jet's son. Thanks, Hannah. Much appreciated. Look forward to setting up a policy and starting the IBC journey. Yes, sir. Okay. Hey, so let's talk about this now. Where do we want to go first? Let's talk about IULs, and then if we have time, I'm going to share the family story with y'all. Okay. This conversation comes up all the time. Let's get this out of the way. Can I technically implement the infinite banking concept with an IUL policy? The answer is yeah, you could, but why would you want to? Oh, damn, I was supposed to find an analogy for us. Because it's like that saying, and I haven't figured out an exact like scenario to tie this to yet, but it's almost saying like, should you do it? Or can you do it? Yeah, you can do it, but should you? Probably not. I guess maybe like in my drug era when I was snorting cocaine, can you do it? Yeah, Hannah, you can do it, but should you? Probably not. There we go. There's a scenario. All right. Anyways, but that's funny. So because here's the main reason. A few reasons, but number one, why it can never work for the infinite banking concept is because you can never pay up the contract. You can never just go inside of an IUL illustration and just never ever stop paying premiums. I mean, can you? Sure, but here's the catch. There is a renewal cost of insurance in that IUL illustration or policy, right? That's just how it's engineered. There's a renewal cost of insurance there. Here's an illustration I'm going to show y'all, and I'll explain it in a second. But there's a renewal cost of insurance in an IUL illustration or policy. In a whole life policy, the cost of insurance technically is the base premium. The base premium, you cannot just go around the base premium. The base premium is the foundation to that contract. You have to have the base premium to even get the whole life contract itself. The base premium can never go up. It can never go down. It's fixed in value. And if you go watch that YouTube video, I explain it deeper, okay, that I put in the comments. But IUL illustrations, there's a renewal cost of the insurance, and your agent always fails to mention that to you, right? Because it has tremendous flexibility. IUL policies have tremendous flexibility that if you're paying like $10,000 a year and something happens and you need to reduce it down to like $50 a month, you could probably do so, depending on the contract, depending on the company. Okay, there's some stuff there. But it has tremendous flexibility with how premiums are being paid. What is crappy though is that as we get older, that cost of the insurance naturally is just going to get more and more expensive. So if we're either not paying premiums or if we're either not making the returns in the market, how our policy was illustrated, it should have been, because y'all, you can't control the markets. What is the whole foundation to the infinite banking contract? What is the whole foundation to the infinite banking concept? Control, liquidity, and freedom. Control. I do not have control over what the markets do. The markets are going to go up, they're going to go down. That's just how history has it, right? It's an investment. An IUL is an investment. My definition of an investment is it can go up in value and it can go down and lose value. It has some risk there. A whole life contract is not an investment. Why? Because it can never go down and lose value. It's a true guaranteed appreciating asset. Let's go back to our whole life illustration. Guaranteed, right there, stamp of guaranteed. Cash value continues to guaranteed to go up, okay? So in layman terms, I explain an IUL illustration or a policy. I keep saying illustration. I'm sorry, y'all. An IUL policy contract, how I look at IUL contracts is it's nothing more than a 1-year term insurance where the cash account on the side gets invested into the market. So it can look pretty good and pretty sexy for people who are younger. But once you start getting to those later stages of life, like the 65, 70, 75 years old, the cash value on the guaranteed side is going to start going down, and even your death benefit's going to go down to the point that it lapses on itself. So let me show you an actual illustration from one of my clients. And I review these illustrations all day long. Y'all, send me an email if you have existing policies. I'm more than happy to review these policies with you. Term, by the way, no, there's no cash value in term, okay? So don't try and go get illustrations on your term policies. It's more so whole life, VUL, IULs, and like just those universal life products. But do you see how there's a guaranteed side and even a non-guaranteed side? This individual, he's 68 years old. He's been in this policy for 12 years. You see that 12 right there? End of year, it says 12. He's been paying $2,025.20 a year in premium. And look at the cash value on the guaranteed side, net account value. You can even look at the cash surrender value if you really, really want. I'm not going to get into like surrender fees and like why this is different here. We can talk about that at another time. But look at the net account value. Year 12, it starts at 53. Year 13, it goes to 50. Then it goes to 47, then 43, then 37. So here's my simple question. Are those numbers going up or are they going down? They're going down. Your cash value is literally going down. And even look at the death benefit does remain level. But because the policy cannot support itself with the premiums you're paying, the returns you're making within that market, the cost of insurance, the cash value will lapse on itself and the policy will lapse on itself to you see where it goes to zero at age 77, year 21. Here's just my philosophy. I do not want to call up one of my clients at 77 years old and say, hey, Mary, so look, the markets aren't doing what they're supposed to be doing. And you're going to have to come out of pocket with $5,000 this year to keep this policy alive and active if you want to keep the policy. But if you don't want to keep the policy, it's okay. The policy has already lapsed on itself. You have no cash value. You have no death benefit. So it was fun doing business with you while it lasted. How freaking shitty is that? Do you see what I'm saying? This is my biggest gripe, and I just need more people to understand this stuff. So, okay, that's on the guaranteed side. Let's just talk about the best case scenario. Non-guaranteed values, 4.2%. Probably without like looking at this illustration for like a few months, probably he had the money invested in like a very conservative like account, if you will. Michael, I will do it. I'm buying 2 condos and I have a real estate mentor now and he's on my ass. I will do it. I'm busy, Michael. Okay, anyways. So non-guaranteed side, look how at the non-guaranteed side, age 86, year 40 is when that non-guaranteed, the best case scenario, if you think you're going to get this case scenario, the cash value starts decreasing. Do you see my little line there underneath net account value? It starts decreasing in year 28. Technically 29. In year 29, it starts to decrease. It goes from 90,422 down to 89, down to 88, down to 87. You see how is it going up or going down is my question. It's going down. And then you'll see where it lapses on itself at year 40 when he's age 96. So I always say, like, can you use it for this? Sure, you could, but should you? Probably not. And if you pay close attention to the IULs, sure, you can. If you're a wealthy individual or you're a wealthy family and you can take on more of this risk, sure, go ahead, take a stab at it if that's what you really want. But here's my opinion. If I want to go and invest in the markets, I'm going to go and invest in the markets directly. Why am I trying to tie a renewal cost of insurance that's only going to go up to my investment portfolio? No, I'm just going to go and invest directly with the market. Last thing I'll say, if I thought an IUL was so great, so fabulous, I would personally own one. But I would never buy one, thus I would never sell one. And with our 30 plus policies just within the Kessler family alone, I'm never going to go buy one. Okay. I mean, seriously, And there's a bad apple out there. I'm going to talk about it. I'm going to talk about it because I'm going to use my platform. There's a bad apple out there. And if you guys want to know deeper, we can talk about it offline. I don't want to totally start drama online, if you will. But there's a bad apple out there, and he's got a huge following. Anytime you would go on one of his webinars, you'd have 400 plus people on there. Long story short, he got in bed with an IUL agent. You know why? Because he's greedy, and I could make a shitload more money selling IUL policies than what I do with whole life policies. I could make way more money. And I think that's really what he was looking at. He was being greedy and he wanted to make more money. So they have been going in because people are following his advice, like it's the truth of God. And he's been telling his people to surrender the whole life policies and get the money into an IUL, a properly structured whole life policy designed for high immediate cash value. He's telling our clients, hey, don't do that. Look at this IUL illustration over here. Y'all, my sticky notes over there, I went on that rant last week. If you understand the concept, the numbers do not matter. Control, freedom, liquidity, protection. That's what I'm looking for. I don't get that in an IUL contract. And what peeves me the most is even the insurance companies who are selling those products. Y'all, IULs came out in the late 80s, early 90s. Late 80s, early 90s when interest rates were high. You know why IULs came out? They came out because insurance companies wanted to stay competitive in the market when interest rates were skyrocketed high. Because in whole life's been around since the late 1800s, early 1900s. I don't know exactly when whole life came about in our country, but I know it's been around longer than our tax code, which has been here since 1913. So late 1800s, early 1900s is when whole life insurance really started to come around. Do you want a product that's withstood the test of time over that long haul, or the product that just came out in the 90s? Literally, those products are 20, almost 30 years old now. They're as old as I am. What do you want? But anyways, that's why the insurance companies created this product, because people are like, well, why would I put my money in a stupid, boring, guaranteed 4%? I could go take it to the market and I could be making 12, 17% right now. And so they just don't understand that, no, this is not the either or, this is your and asset. You run the money through the policy first, and then you take it out and go place that trade in the market if that's what you want to go do. I'm personally just not a markets girl, back to my foundation of my financial life: control, liquidity, freedom, protection. That's why I like real estate. That's why I'm into real estate, because real estate has withstood the test of time. It's always gone up in value, even though right now, here, in my condo in Daytona Beach, I bought at the top of the market. I totally did. I totally overpaid for this condo, but I wanted it so bad. So right now, my house is worth $80,000 less than what I bought it for. That's what Zillow tells me. And how confident can we really be on Zillow? I don't know. But it's about $80,000 less than what I bought it for. But here's what my dad has taught me. And my father is going to be 59 this year. He's been an investor for a long time. He says, the only purchase I ever regret not buying is a piece of property or a piece of land, because it has always gone up in value. He still to this day talks about this Madeira Beach condo over in the Tampa, St. Pete area. He still to this day talks about that Madeira Beach condo. And he's like, oh my God, I should have bought that. If I would have bought it back then, it would have cost me $250,000. Now it's worth over $500,000. The shit goes up, So, and that's probably inflation, cost of living, because our dollar's not tied to gold and the government can go do whatever in the hell they want. Topic for another time. But anyway, so he's always said that the purchase I never regret not buying is always a piece of property. So I'm buying actually these two condos more so for tax purposes, because being a lender, it's really crappy on the tax side. I got to report all of that as income, right? And so I've really been getting hit on taxes. So I'm trying to figure it out where I can use depreciation, I can use cost segregation so that I can minimize my tax bill. So just FYI, it's going to be in Atlantic City, New Jersey. It's going to be a long-term rental. So I mean, I'm open to short-term rentals, but probably it's going to be a long-term rental. So if you are looking for a place in Atlantic City, New Jersey to live, and it's right on a canal, holler at your girl. Okay. Hold on. Yes, Brad, that's exactly what I want to go. Okay, hold on. I got to go in order. Is it possible to use other financial tools to IPF? Oh, I know. Here, hold on. Read this together with me. Dave says, good morning, Dave, by the way. It is possible to use other financial tools to do the IBC, but from the little I know, the mutual whole life seems to be the best tool for the concept in most cases. Yes, sir. Oh, Chris. Good morning, Chris. Oh, it's Snaggy. Snaggy, call me back, bro. We need to talk. Okay, Brad, thank you. This is exactly what I want to get into next. Just search Kyle Busch insurance lawsuit in Google. Who sued his IUL provider? Bingo. Can I, okay, so here, let me post this article because they actually like literally just settled like last month. So here's the article. So the lawsuit got settled. There you go. Okay, I'm new to StreamYard, y'all. Okay, so can I share screen? Beautiful. Look at this. Perfect. Okay, here's the article. Oh, I got to add it to screen. Oh, and Mr. Brad, I got to take off your comment. There we go. Let's make it big like this. Okay, there we go. This is an article that was posted February 27th of 2026. Today is the 26th. So it's about a month ago this article got posted. Let's just read it together. NASCAR great Kyle Busch settles IUL suit against Pacific Life agent. The agreement ends a high-profile lawsuit over Index Universal Life policies sold as a retirement income strategy. Celebrated NASCAR champion Kyle Busch and his wife Samantha have settled their legal dispute with Pacific Life and agent Rodney Smith. Ooh, Rodney, you be putting on blast right now. Over a retirement income strategy in which the Bushes claim to have lost more than $8.5 million. Terms of the settlement were confidential. In a joint notice of settlement issued Thursday, both sides said they expect to file a motion for dismissal within the next 30 days, according to a filing in U.S. District Court for the Western District of North Carolina. In quotes, the parties respectfully request that the court stay all pending deadlines while the parties finalize their settlement and file such joint stipulation or motion for dismissal with the court. The Bushes sued Pacific Life, the agent Smith, and Smith's insurance business, Red River LLC, damn, they putting them all on blast, in October. So October of 2025 is when they sued, and alleged that the insurer, am I saying that right? Alleged, and alleged that the insurer and its agent had foisted on the couple a scheme of deception involving a portfolio of Index Universal Life policies. So it seems like they had multiple IUL policies because it says portfolio. The couple claimed they paid more than $10.4 million in premium, resulting in out-of-pocket losses exceeding $8.5 million, according to the filing. So they paid 10.4 and they lost 8.5 is what they're claiming. In response, Pacific Life in January asked the court to dismiss the complaint, indicating that the Bushes' claims were filed with inflammatory and disingenuous rhetoric. do I really know what all those big words are? Not really, but let's move on. We can talk about that later. And never revealed any wrongful conduct by the insurer. So here's literally what they're saying. I was on the phone with my dad yesterday talking about this stuff. Literally what Pacific Life is saying is they showed you, Mr. Client, an illustration because you have to sign off on the illustration. You have to sign off on the policy contract. This is contract law, right? So you, Kyle and Samantha Busch, you had to sign off on the policy contract and on the policy illustration itself. So when you see this guarantees within the illustrations going to zero, bro, that's not on us. We showed you, you signed your name here on the dotted line. That's you. But really what the agent failed to do, that Rodney Smith guy, he failed to go through the illustration and talk all through the different weeds. See, whole life is very black and white. IUL is very gray, right? There's so many moving parts to it. So that's what Pacific Life is saying. Legally, and honestly, legally, they have a claim here. Okay, I watch a lot of Judge Marilyn, People's Court. I like Judge Marilyn over Judge Judy personally, but this is all contract law. That's what it is at the end of the day. So Pacific Life is legally right. Kyle, you signed your name here. You knew what you were getting yourself into. So why are you trying to come back and sue us now? Let's continue on. Plaintiffs were fully capable, and this is exactly right here. Plaintiffs were fully capable of evaluating the economics of their policies, and there is no support for their allegation that they could not evaluate the real world, that they could not evaluate the real world operation of the policies. Pacific Life said in its motion to dismiss. So literally what I just said. Plaintiffs, Kyle and Samantha Busch, you were fully capable of evaluating the economics of your policies. You saw the illustration, you saw the contract, and so now your allegations have to be dismissed and thrown out the door. And no, we're not going to pay any legal claims or fees because you knew what you're signing up and you knew what you're walking into. Busch is one of the highest profile policyholders to turn up in a legal dispute facing the life insurance industry surrounding the marketing of index universal life policies. Get this, last thing. Separately, Pacific Life agreed recently to a $58 million settlement for a class action lawsuit in California involving allegations of using misleading illustrations to market Pacific Discovery Accelerator IUL policies. Even how they, is that accelerator? Is that how you're going to spell accelerator, y'all? What are you guys, like freaking Gen Z over there in your marketing department? So yeah, bro, stuff's going on and you guys need to wake up. Stop just taking all these freaking agents like for their word for it. This is why I always say, think for yourself and question. Okay, so to go back, one thing I failed to mention on that guy, the bad apple out there selling IULs, taking whole life policies built with properly structured whole life and with properly structured whole life policies with paid up edition premium. You taking those policies and surrendering them for people to then put the money into IULs, and you are not going through the proper 1035 channels, because that's what it is. There's literally laws for a reason, my people. 1035. Y'all know what a 1031 exchange is in the real estate space, right? And if you don't, we can talk about it later. But a 1031 in the real estate space is the same thing as a 1035 in the life insurance space. It's just life insurance compared to real estate. So instead of you taking the money from the whole life, internally transferring it over dollar for dollar tax free into the new IUL, you're making your people surrender the policies, because on a 1035 statement, you, the agent, have to tell the insurance company and essentially the Department of Insurance, why are you 1035ing this policy? What is the reason that you're doing this? Because they are protecting the policy holders, because again, there's bad apples out there. People will just want to sell you a policy just to make a commission buck. And so to protect their policyholders from agents just being slimy and just wanting to collect commission money from people, that's why you have to explain why a 1035 is happening. But he's not doing that. He's literally telling his people, just surrender the contract. The insurance company will send you whatever cash values in your policy. It will hit your bank account, then bank account put it into the new IUL policy. So you know what? And I hope you hear this, Bad Apple. I'm coming after your ass, honestly. It was like a conversation, and this has been going on for like a year now, but it's a conversation that keeps coming up. I let it settle. I was like, okay, what battles do I really want to fight? Right? I mean, it's legal. I'm going to probably have to get an attorney to draft a letter, a formal complaint to the Department of Insurance and that insurance company that you do business with. But I'm like, I'm 26 years old. I'll be 27 in August. If I don't do something, who else is going to do something? And who actually like has a case here and who actually has notes and like a long history of people doing this? Y'all, I'm not saying it's just like one or two policies. Out of like the 200 plus people that we've started and we've helped out of that group, it's about 20. That's 10%. And I was like, ugh. Once you hit the 10% mark, I'm like, okay, maybe I got to do something here. Anyways, that's in my brain. Hopefully I'm not being so honest. I mean, I like being honest with y'all. That's just what's going on. Like, let's just speak the truth, you know, and if people like it, they'll vibe with it. And if they don't, they don't, you know, they're just not your people. So anyways, that's my last ending thoughts on IULs for right now. You can go to my YouTube channel, The Money Multiplier, or go to Money Multiplier. Sorry, it's the podcast show. Go to the Money Multiplier YouTube or on podcasts. You can literally search it up, IUL, on there, and you can see all the content that I've done already on IULs, where we can get deeper and deeper into this stuff. But we are ranging here at the 10-15 hour. I do have an out of office appointment. I got to fix my nail. I had too much fun this weekend at the music festival and I broke a nail. So I'm going to go see Tin. Tin, you may be joining me from Facebook today. So good morning, sir. I'm going to see you in just a little bit. Then I come back and I got meetings all today. So I am going to be here. Let's kind of segue. Okay. I didn't get into my family story, so we'll save that for next week, unless I do have Chris Brown coming on from one of the insurance companies. He's at One America and he explains dividends very, very well. And so I'm just trying to coordinate for him to come on to a live stream with me at some point. So if he's not here next week, this is what we're going to be getting into next week. I'm going to read a comment for y'all. But if he is here, then we'll talk about this in 2 weeks. Okay. So just stick around and come and hang out. I want to share my screen. I'm going to do one more share screen. Share screen. I want us to read these comments here. Okay. And this is what we're going to talk about next week. A gentleman named Jake chimed in 7 days ago on one of my recent podcast episodes. And this was actually me speaking on stage at our Tampa event. If you weren't there, you missed out. Sorry. Annette was there. Alfredo was there. Dave, you were there. Dexter, you suck. You weren't there. Anyways, he goes, I think this was the first one. There was one truly absurd comment here. If your brother's airline matches 60%, it is absolutely bonkers not to take that match. That is 100% guaranteed return instantly. Even if that is just in cash equivalent fund within the 401k, he will never see a return like that, ... ever. Not in an IBC account and not in the market. He should take that match and run, and then do IBC with whatever is left. You are you also conveniently never address the Roth IRA, 401ks in comparing IBC to retirement accounts. I see the value in IBC, but anyone not taking advantage of employer match and Roth options is wasting money, plain and simple. I have so many thoughts. And I hear it. I love comments like this because it allows us to grow. Okay. I'm not going to spend today talking about it, but this is what I want to talk about. I want to get deeper into this. Last comment. Let's see what he said on here. Also, just to be clear, the other fancy building in every town and city is the mutual insurance company. Make no mistake, the life insurance companies and agents are making a killing off of their clients, including IBC clients, even if the PUA commissions aren't as much as their preferred policies. So you do have to account for commissions and fees in this process. So you're not making the banks rich, you're making different billion-dollar companies rich. It might help you make money and control your money, but there is a significant cost. Oh, this is fueling my soul right now. I love this comment because mindset here. Okay, number one, he's kind of coming at this with like a naysayer attitude, which I love. I love conversations like this because sometimes like when everybody's on board with me and like we have the same thought process, like, yeah, it's fun, but sometimes it's like kind of fun to like challenge me. You know, I should have been in debate growing up. Why did I do debate? How fun. Anyways, so I want to get into these two comments here. Okay. We'll talk about this next week or the week after. And last thing, here, let me give you one more resource because to his point, we get into this. Jonah Dew and I did a podcast together 11 months ago. I'm going to put this into the chat box. If your financial advisor is telling you to defer your taxes, run. Featuring Jonah Dew. That would be my comment. Oh, maybe that's what I'll do. Let's go comment right now. Let's go do it. Hold on. Where did I say? Hey, talked about you on live stream today. Okay. Oh, no, but I need to reply to him at Jake. How do we do that? Okay, there we go. Reply. There we go. Okay. Yay. Thanks, y'all. All right. Until next week. Okay. 9 a.m. Eastern time. I will see you back here. In the meantime, podcast show goes out every Tuesday. Next Tuesday, I got a fun episode. You should really tune in. Oh, sorry. I forgot to copy this link for you all in my chat box right now. Here. Okay, there's another good video. Podcast show comes out Tuesday. You should look at the recent episode. Carson Hurling joined me. Carson's so good. He's so cool. He's another money mentor on the team to kind of get into that conversation again. And then also, I have blogs. If you guys are readers, if reading is like the best way to learn, go to hannahkessler.com. There's blog posts posted up every week on there. I think they're very good. I like them, but that's also another good resource to continue on your education. All right. Miss Jet says, have a good day. Glad to join this morning. Thank you for being here, my lovely. All right, y'all. Do well. Be good. Think for yourself and question. And until next week, I'll see you then. Mwah. Bye, everyone.